Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at FTAI, or FTAI Aviation Ltd. FTAI is an aerospace company. It owns and maintains commercial jet engines with a focus on CFM56 engines. Here is the barchart.com technical opinion rating for FTAI. The bar chart rating is an 80% buy with a weakening short-term outlook on maintaining the current direction. Long-term indicators fully support continuation of the trend. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that FTAI is well above the moving average line, so the monthly trend in FTAI is up. Now we're going to look at the daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since the chart started, so the daily trend is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. FTAI is below the upper Keltner channel line, so FTAI is inside the buy zone. Since the trend is up, we want to buy a call. FTAI has 9 option chains to choose from. We're going to use the December 20 option chain. Right now, the December 20 options have 48 days to expiration. Here's part of the FTAI option chain for DC20. FTAI closed at 142.46 on Friday. That means any calls on the list from 80 to 140 are in the money. Let's take a look at the profit potential for purchasing the 140 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 140 call is 1160 to 1180. We try to enter at the midpoint, so we'll use 1170 as the buy price. Our call option calculator shows the profit potential for this call based on FTAI price changes at option expiration from flat to a 12.5% increase in price. We can see that if the FTAI stock price is flat at 142.46 at option expiration, the 140 call will lose 79% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 120 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 120 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the FTAI stock price is up 1%, the 120 call will lose 2.5% of its value. We want that to be break even or better, so the 120 call does not meet our requirements. Let's see if the 100 call will work. The bid-ask spread for the 100 call is 41.90 to 44.20. We try to enter near the midpoint, so we'll use 43 even as the buy price. The 100 call works. If the FTAI stock price is up 1%, the 100 call will make a 2.1% or $88 profit. That's better than break even, so the 100 call is the one we'll buy. The call option purchase calculator also shows that if the FTAI stock price increases by 2.5%, the 100 call will make a 7% or $302 profit. If the FTAI stock price increases by 5%, the 100 call will make a 15.3% or $658 profit. If the FTAI stock price increases by 7.5%, the 100 call will make a 23.6, got a little dyslexic, or $1,014 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that the FTAI stock price does not make the expected move up and remains flat at expiration, the 100 call would only lose minus 1.3% or minus $79 compared to the minus 70, only 1.3% or minus $54 compared to the minus 79% or minus $924 loss for the 140 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the FTAI DC-20 120 strike call and sell to open the DC-20 130 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 120 call for $24.50 and sell the 130 call for $17 even. $24.50 minus $17 even equals $750. So the entry price or debit cost for the spread is $750. The call option spread analysis calculator picture shows that the spread will make a 33% or $250 profit if the FTAI stock price declines by 7.5%, remains flat, or increases in price when the options expire. Creating the debit spread will allow us to collect a $1,700 cash credit to our brokerage account for the sale of the 130 call. As we said on the previous slide, this reduces the cost of entering the spread to $750. Here's a note regarding earnings reports. The next FTAI earnings report is scheduled for Jan 29. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the FTAI December 20 100 strike call for 43 even. We also reviewed the spread. The spread said to buy to open the FTAI December 20 120 strike call and sell to open the FTAI December 20 130 strike call at a debit of $750. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.